Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. All right, and we're back for another week. Paul, how's your week going, man?
It's going good. We get our first night of basketball tonight.
Oh, same here.
Yeah. So 6:30 practice, and I think he's got practice every day this week. But we're driving to Tennessee on Friday morning, so he'll miss one of the practices, I think, Friday night.
Oh, that's a lot of
40
practice.
weekend, yeah, it is. Well, they're gonna need it.
Yeah. So I got my youngest playing basketball too. His first practice is tonight. It's just 2 days a week, and then a game on Saturday. So
Yeah.
man, way easier of a schedule than hockey was the last several years of my life. That now he's not playing hockey, playing basketball. Really looking forward to my winter now.
Yeah. Basketball it's low. There's no equipment. You show up with your shoes and your shorts and some water, and you go to town.
Yeah. And it's comfortable to be at the games, watching the games.
Yes.
You're not leaving the cold air outside to go to the cold rink inside as a fan, just sitting there watching. So yeah, I'm looking forward to it, man.
And it's
so-
cheaper.
Oh yeah, it's easier on the pocketbook and much easier on the schedule, which is to me the most painful part of hockey.
Yeah.
Love watching
Hockey
hockey.
parents, it's a huge commitment. Good. I mean, I get some friends that their kids are in hockey, and it's insane.
Yeah, the time commitment is outrageous. So, and then some states, if you don't live in Minnesota, like you're basically getting on an airplane and traveling for tournaments, which is blows my mind. I wouldn't do that. But in everybody I talk to who lives in a different state that does hockey, they have to. Here, luckily, you don't have to because everybody plays hockey. So you got plenty of competition and all that. So yeah, man. Well, daylight savings waved goodbye, and now it's getting dark at like 5 o'clock here. So I think the sun is setting while we're recording.
Yeah, you're because you're an hour behind me, right? So I'm at 5:30 here, and it's dark.
Yeah. Yep.
I like it though.
Welcome to winter.
Makes me want to go to bed earlier.
Well, that's a good thing. When you got all these kids at home, it's like now they're getting tired earlier. It's a lot easier to get them to convince them it's later than it actually is.
That's right.
Yeah, that is nice. All right, man. Well, hey, we haven't done an episode solely dedicated to using infinite banking as a retirement tool. So
yeah,
we thought, why don't we just make that, a complete episode of its own and talk about all the benefits of this as a retirement tool. Most people we work with are roughly, our age, plus or minus a few years on either side. So they have plenty of years until retirement for the most part.
Let's remind everyone how old you are.
Yeah. I mean, can you say low 40s?
I think you have to say mid now.
I think mid is more accurate. Like 44 to 46 is mid, and then it's 47.
I'm still technically early 40s.
Yeah.
For the next month and a half.
Yeah. Not until your mid 40s do you really have any wisdom in life. So you'll get there.
True. Especially as a man.
Yeah, for sure. I think your brain is finally fully developed at 44 years old as a man.
Yeah. We'll see.
But your maturity, you stopped aging and maturity wise, I think about junior year of high school.
Yeah, that's probably right.
Sounds about right.
Yeah. Might have even regressed a little bit.
As evidenced by the pre-conversations we had before we hit record. Anyway, back to the topic at hand. So infinite banking as a retirement tool. So most people, they want to get into infinite banking to start taking control of our capital today, right? And get all the benefits of specially designed dividend paying whole life insurance today to finance the things of life and do, your investing and your big purchases, everything else, right? and the retirement, or let's just call it passive income years. Nelson hated the word retirement. So do we.
Yep.
Your passive income years is when this creates an entirely new benefit and multiple options. If you have this in place for passive income years, than any other tool out there. In fact, some people call this, refer to this as, they kind of market it as a life insurance retirement plan. So
right.
We don't do that.
LIRP.
The LIRP. Yeah.
The LIRP. It's easy to say.
Yeah. I would have thought of a cooler acronym.
But I think of that, and it's similar to like Army acronyms, like LARS.
Yeah.
But yeah, is it the ultimate, kind of retirement tool, like the process of IBC, using dividend paying whole life structured for IBC? We've kind of sporadically talked about how great this product is. The process is the process, but the product of dividend paying whole life is just a phenomenal thing that we all wish, once we get into this, that we had known about 20 something years ago, or that our parents or grandparents had gotten into it. Or how they sold insurance and still didn't know about it. But yeah, I read something today where it's, yes, I want to control the capital now, but I also want to control it tomorrow as well. And for the rest of my life, I want to have ultimate control. And that's what this process and this product is going to enable us to do as we go into those passive income years.
Yeah, absolutely. And in your passive income years, like we've said before, you only need one thing to retire, and that's income, right? And passive income, because you're no longer actively earning an income. So everything you live on is coming to you passively. Now, during those passive income years, there's 3 types of income you'll receive during those years, right? We just like to categorize it in 3 buckets. So you have your tax deferred bucket, your taxable, and your tax free. If you could choose one of those 3 to keep the majority of your capital, which one would you choose, Paul?
The tax free bucket.
Tax free sounds good to me. Yes. Do you know what the tax rates are going to be during your passive income years, 15, 20 years from now?
I have no idea.
Do you know what your income bracket is going to be?
Likely high.
Likely high, right? Do you know what the market's going to be doing that year? That you decide to start taking passive income?
I have no idea.
Or every year after? Yeah. Do you know what kind of return you're going to be getting, or what kind of return you will have gotten by that point?
Right. There's a lot of, it's almost like the future's unknown, Dave.
Almost like the future's unknown. Do we know what inflation will have done, et cetera, et cetera. So if you got all of your money in a tax deferred bucket, you're kicking the can down the road, as they say. So you're going to pay taxes someday. And, if you, when we had our buddy Paul Horsley on the show a couple episodes ago, he was talking about the ear of corn, putting a kernel of corn in one hand and an ear of corn in the other, and say, which one would you rather pay taxes on?
Right.
The seed or the harvest?
Right.
So
the seed, for sure.
Yeah. And you have the choice.
Yeah, that's right. And unfortunately, Dave, most Americans, have been, between the government and Wall Street, have been sold this bill of goods for now several generations, right? Where it's, hey, hand your control of your money over here into these things that we created called qualified plans. And some people love these things, right? They think it's like the best thing. I listen to these financial shows on the weekend, and it's just, it's the same old, and I've said this, but it's the same old tired advice, this and that. They do talk about, non-taxable buckets, but it's like an afterthought. Like, oh, and by the way, and it's the Roth, which you can almost put no money in, folks. Let's face it. If you're doing halfway decent nowadays, you make too much money, contribute anyway.
I hear that all the time talking to clients. Well, the only tax-free bucket I have is the Roth IRA, but I've already surpassed my ability to fund that. I make too much money. Like, that's actually a problem now. So,
right. And I haven't kept up on whether the backdoor option is still available. I thought I had read somewhere anecdotally that it had gone away with one of the tax changes over the last 3 years, but I'm not sure, so don't quote me on that. But even still, you're putting bureaucrats and government agencies, non-elected officials, in between you and your money by
That's
doing.
That's a good way to visualize it. Yeah.
Yeah, you're the quarterback. You're trying to score a touchdown. In your way are like, a bunch of dudes that weigh 300 pounds. Well, that's the government.
Yeah.
The end zone is where your money is.
Yeah.
You're not going to get there. I'm 160 pounds. I'm not getting there. And somehow these dudes can run as fast as I can, right? So yeah, and they limit, right? They limit how much you can put in that Roth, for example. Everyone's like, oh, Roth, self-directed, all this stuff. I can only put $6,500 in it. And we talked before we hit record. What am I really able to save with $6,500 a year, assuming I get 5% year on year return, 6%? Oh, well, probably gonna get 12.
Yeah.
Not.
Maybe you'll have a few $100,000.
Yeah, I didn't do the math, but
maybe
40 years.
If you were contributing that for 40 years, yeah, maybe you have a few $100,000.
Yeah.
But which that's better than nothing. At least that is something you can pull from when you need to supplement that taxable income. But yeah, most people have the qualified retirement plans, which, hey, a lot of employers offer a match, and there's an argument to go up to the match. I'm not going to get into that argument right now, but there's some employers also that fund a retirement plan, a qualified plan for you, and you don't have to put a dime in yourself. Great.
Yes.
That's great. Phenomenal, man.
Yeah. I think, what a tremendous advantage those guys have. Like, it makes sense for them to, something's being done for them, right? Like, yes, this is literally, I hate saying this, but it's literally free money to them. Sure. And now they have the ability to say, hey, I've got this advisor that is, kind of well-read, and he's telling me, hey, look at this other asset class. You might want to consider this, and here's why.
Yeah.
And now they can take funds that we as employees had to contribute ourselves, but now since my employer's doing it for me to the max that I'm allowed by the IRS to put into this thing, the 401k, now I have all this other capital that I can put into a place that I can get to it. And what a phenomenal thing that is.
Well,
that particular segment of people.
If you've got an advisor who actually brings this to your attention, the fact that, hey, here's an asset where you can put money and get guarantees, and it doesn't have any market correlation, and it's going to grow, and you'll be able to access all that growth tax free for the rest of your life, and you'll be able to use it in retirement to offset that taxable income, or to pull from when you don't want to pull out of a down market, etc. Like, that's gold. If somebody's telling you that, like, they've got your best interest in mind. I'm sorry, if you quote yourself as a fiduciary, I'm a fiduciary.
Love that word.
Like, that means something. Yet I'm not going to tell you anything about, in our opinion, one of the greatest financial tools available, because mainstream advice is that that's a stupid thing to do. It's a stupid place to keep your money. It's a terrible investment, quote.
Terrible.
Right? Then they're not really doing their job. Right?
Yeah. Or they don't know.
Yeah. Or they're just plain ignorant. So,
and that's, let's face it, all these fancy acronyms some people have it can mean something, but it also doesn't mean something most of the time in my experience.
Yeah.
So.
Yeah. I mean, kind of like, I don't know, a lot of professions, you only know what you've been told, and you only know what you've been told to learn. It's people who kind of break out of that mold and are able to look outside of that lane that they've been stovepiped into, saying, hey, you got to stick to just this. Here's your left and right limits. But they're like, well, what's over here? What's beyond that? Oh, look at this. There's more out there. Those are the people that I would trust what they have to say.
Yeah, no doubt.
Yeah.
And they should be doing those things. Unfortunately, Dave, and folks, you can check with your particular advisor. He might be, or she might be, a captive agent.
Right.
And that captive agent is not allowed to tell you that you should go do those things. Perhaps maybe they have something in their contract, because they're usually 1099 contractors for these firms. So you might want to ask them, oh, don't do that. Put more money in your whatever. Well, there's a reason that they're telling you that. So anyway, it's,
Yeah.
it is what it is, but knowledge is power. And if you can, anyone can, you said this last week, Dave. I listened to our episode today just to listen, but anyone can do IBC.
True.
Right?
Yeah.
You don't have to be rich. That's a myth. It's not the rich man's Roth. I've heard that thrown out there before. It's like, what? No.
Yeah. I don't even know what defines rich or not anyway.
Yeah. What does that even mean?
Who's to say what's rich and what's not?
If you ask Anthony, Jeff Bezos.
Yeah.
My son's like, yep, that dude's rich.
Yep.
Look at that boat, Dad. I was like, yeah, look at that thing.
Yeah, for sure.
He's rich.
But so the great thing about this is compared to the Roth, you have limitations on your income. It caps you out. You have limitations on how much you can fund every year. And then that's it. Right. And then, but you compare that with dividend paying whole life insurance, there's no limitations whatsoever. Like your income doesn't matter. In fact, the more income you make, the better.
Yes.
Right. You get rewarded by the more income. Isn't that a novel idea? Reward people based on their productivity, their economic productivity. That's the way life insurance works. The more money you make, the more human life value you have. Therefore, the more life insurance you can obtain. And there's no limitations really on how much you can contribute. There's ways, the life insurance companies are going to have their guidelines, but there's certainly ways, legal and ethical ways to get around those guidelines and fund a lot more capital into those. Basically, no limit. You can figure it out to where there's no limit on how much you can put in.
You may reach, and man, if you're doing this, good on you, but you may reach a certain level of death benefit with one particular company where they may say, I know you've got the premium dollars available, but our exposure to this one life based on the size of the company, whatever, is just, we're not willing to go past whatever amount of money that is. But luckily for us in America here, there's there's plentiful old mutual life insurance companies that offer products that you can practice IBC with. So,
yeah, right. So lots of options, and you can insure your spouse, you can insure your kids, other insurable interests. So there's really no limit to how much you can put into this and start creating that tax-free wealth later on in life during those passive income years. So we're not saying this should be the only thing you do. This is just an addition. I think, one advisor I like to work closely with thinks you should do 20 to 25% of this as your overall portfolio. So now you have some safe money. You've got some guarantees in place that cover basic necessities at a minimum when you get older, so that no matter what's happening in the market, you've got cash available. You've got more options. So let's talk about that specifically during those passive income years. How does a dividend paying whole life insurance policy function as a volatility buffer?
Yeah, well, it's not correlated to what's going on Wall Street, right? So, lately the last several years, the market's been sort of crazy. Like last week, the Dow was down and it dipped into the 32,000s, and now it's back up to, well over 34,000, right? Just in a matter of a few days. So it was kind of crazy, right? That's a few percentage points, but we've seen it move 15 or 20% in a short amount of time. So no market correlation means that if the market, let's say I'm 60 something years old, I'm in my passive income years, and the market takes a dip, well, maybe I'm not taking that 3% or 4% out of that 401k that I, stuffed a bunch of money into over the years, or that traditional IRA or something. Maybe I'm taking it via a policy loan because I listened to that advisor and I paid adequate premium relative to my income, and I paid 20% of my income and premium for 30 or 40 years. So
why don't you
love it as
a
volatility?
Yeah, and why would you not want to take money out of the market while it's down?
Is that a serious question?
Yeah, I'm just trying to break it down. We may have some first time listeners who haven't been around this kind of discussion before.
Sure. No, I'm
right?
just kidding.
So there may be, I mean, if you would have asked me that 20, 25 years ago, I probably would have had no idea.
Well, I'll say the answer is obvious, right? The market's down, the account value is worth less because your shares that you're holding are worth less, and now you're having to take more shares and sell them to get the amount of money that you ultimately would have needed at a different or higher share price prior to the market dipping, right? And that's a terrible, and what I wanted to say was that's a terrible position to find yourself in. And a lot of millions of Americans every 15 years when the Fed manipulates the market, or every 10, whatever it is, through bad policy, low interest rates and crappy lending standards and all these other things, people are forced into that. Like, well, I have no other source other than my little Social Security or whatever through which to gain, to glean income from. So
yeah,
they're between Barack and a hard place.
But ching. So, but that it comes down to the fact that they don't have any other source of income. So they're forced to take money out of a down market, which a little thing called sequence of returns risk. If you're taking money, if you're in those passive income years in your 60s and 70s, you're taking money out of a down market. I'm sorry, actuarial science says you don't have enough time left on this earth to make up for that.
That's right.
You're basically, you're kicking the horse while it's down.
Yes.
And you're making it even worse.
Yes. Absolutely terrible. So, if we're practicing IBC and we're being an honest banker and we've done it for a long time, we don't have to worry about that as much. And you have enough worries when you're dipping into your 70s and 80s and 90s as far as age, right? Hell, I was reading an article by Carlos Lara today, just talking about the obesity in this country and, what percentage of disposable income people end up spending on medical costs, and how, gosh, it was a high percentage, Dave, of bankruptcies are caused by people that have unpaid medical bills they just can't afford, right?
Yep. Absolutely.
And and he talked about his own experience with what happened to him, and how he was able to dip into his life insurance cash value to supplement some, because he wasn't able to work or do much at all for a period of time. So
right.
That's a real experience.
Yeah. So you got that volatility buffer. You're also creating what some companies may offer, and the military offers a survivor benefit plan, right?
Yeah.
Like where you're getting a pension from any company where you get a pension, which may not be too many people these days, but there's a handful.
Sure.
There's probably a survivor benefit plan option, which is you take less money during those years and the company keeps part of your pension to essentially fund a life insurance policy on your behalf that pays your spouse, 50% of your pension after you die. Of course, you're taking on the risk. You have to die first for that to be a financially good move. Your spouse has to outlive you by a certain number of years, right? Like there's you're taking on some risk there.
Yeah. In fact, I had this exact conversation via email with one of my newest clients. He's a retired Army colonel and he's a listener. So we talked exactly that. He's like, odds are, looking at it logically, we will die within a few years of each other.
Right.
And that's true. So you would have given up, I think it's 6.5% of a military pension for years.
For what? To receive 50% of his pension, which is 50% of what his base pay was, which is like a quarter of what he was making active duty. So correct. She'll receive an eighth of what he was making when he was on active duty.
That is definitely a very close, that's a fairly accurate swag of what it actually would come down to. And then it's taxed.
And then, I think not all of them are. But I believe the military one is, right? It's taxable income.
Oh, yeah.
So, right. Because you're not, it is. So, so how, is assuming you're making 50 grand a year in that pension, that military pension, is your spouse going to be able to live off 25 grand a year after you're gone? What's that going to do? I mean,
Not much.
not a whole lot.
Not where I live. Not where you live either.
No, definitely not. So yeah, so that's just another option that you have. Here's a big one. How about freedom to spend? How many retirees does everybody know? Maybe your parents who are afraid to spend money because they don't want to outlive it, right? So how does this give you the freedom to spend?
Well, again, and folks, your agent, or we, if we're your agent, we can illustrate how you can take, guaranteed, reliable income off a policy to either supplement what other things you had going on. If you had a pension, if you had 401ks or IRAs, whatever you had. So you have Social Security, maybe if it's not insolvent by 2034, which it will be unless they make some drastic changes to it. Anyway, so yeah, you can use it. It's I guess what I would like to say, it's going to be the asset that's going to be there for you.
Yeah.
It's going to be the one that you can rely on when all this other stuff is just, you don't want to have to think about it, right? It's going to be there. You can always get to your cash value. Your contractual access to that capital is going to be there for you. So, yeah.
And the reason you have freedom to spend it all down while you're alive is that, hey, if you're afraid that, you're going to die a long time before your spouse, let's say in this case, you're going to die a long time before Tammy. It doesn't matter because when you die, she's getting millions of dollars of tax-free income.
Boom. That's right.
Millions. So does it really matter if you go dip into your TSP, and just completely obliterate those accounts while you're alive? Doesn't matter. She's going to have more than enough after you're gone because, you're the one that spends the money in the family anyway. She can just sell all of your cars.
That's
probably
right.
Put the kids through college twice by selling all those cars.
Yeah. So exactly. So not only do I have the living benefits while I'm alive, right, which was the stuff I touched upon, but I could spend down that 401k. I can ignore, well, maybe I wouldn't, but I could ignore secrets of return risk if I really wanted to. If I wanted this widget over here, I could go, just take the money out of it. Who cares what the market's doing, right?
Yeah.
Because I know I've got that massive income tax-free, maybe some estate tax, but there's things you can do. That's a different episode. We'd have to bring on an attorney or something.
Yeah.
So yeah, get that massive windfall that replenishes. Maybe we get some loans out, maybe whatever. But yeah, I liked how that, I can't remember who said that, but yeah, the freedom to spend.
And guess what? Nobody curses your name after you're gone now because you left grandma in a bad situation. And now that your kids got to take care of your wife and all that, because dad didn't plan.
And I tell you that is the most common occurrence out there in the wide world right now. And we see it every day. Like I can't tell you how many people I've known, just secondhand here, friends or other family members where somebody in the family died suddenly. In fact, I had a client whose uncle just passed away.
Yeah.
60 years old. So not old. Kids are, out of the house, I think, in their mid 20s, late or early 30s, but still, had dad left $1 million, obviously we're still going to be devastated because dad's gone, but oh my goodness, like we were able to pay for the funeral. We were able to settle some whatever, just whatever.
Right.
But that's never the case. Never the case.
Just put it this way. Nobody's going to be creating a GoFundMe page for your family when you're gone.
Right.
Right.
That's right. I've seen that too with the Hawaii
I see it all the time. Let's put GoFundMe out of business. Taking care of everybody after the breadwinner dies unexpectedly or, whatever, and leaves nothing but debt. Worst case, or just, no assets remaining. So
that's right.
Yeah. GoFundMe is not a
plan. That's not a plan.
That's not a plan.
It's almost like buy term and invest the difference.
It's not a plan. Yeah.
It's a slogan. But folks, you get enough risk in your life. And that strategy for sure, or that slogan for sure, doesn't help you.
Yeah.
So be careful what advice you're listening to out there.
Yeah. Just
You know who I'm talking about.
On a new car, you're not going to get collision and invest the difference of what it costs to get full coverage. Right? Nobody in their right mind would do that with a brand new car.
Right.
Yet you do it with your life.
Unless you're Jeff Bezos rich.
Yeah. Who cares?
Yeah. Then you're just getting liability. Maybe.
Yeah. Once the new car smell wears off, you just get a new one. Because man, that's a good smell.
It is a good smell. It's still in our new car. You still got it. It's nice.
I wonder how long it lasts when you don't have kids. I bet that new smell lasts for 20,000 miles easy.
Yep.
With kids, it's like 3,000 miles. That new smell is gone.
That's right.
Yeah. Oh, here's one. How am I going to fund this in retirement? I don't want to get into this conversation because there's a lot of ways to fund this. I'm just going to tell everybody, go listen to episode 32.
Perfect.
From September 19, 2022.
Oh, wow.
How can I continue funding my premiums when I retire? That episode will spell that out, and you will have zero worries about funding your premium in retirement.
Right. That's the big assumption, right? Hey, if I stop working, I have no money. Like, how do I continue to pay this premium that's illustrated at age 95 or age 100 or age 75, maybe in some cases?
Right. Well, imagine this. Imagine you've had this policy in place for 20 or 30 years, and you stop working, and you have somewhere where you could put in $1 and get $5 back. Do you think you'd come up with $1 to put in there, or maybe $10,000 or $20,000?
Yes.
I think you will. Yeah.
Yes.
So,
yep.
There you go.
Yep. Talk to your agents. There's non-forfeiture options, and there's other options. There's premium offset, which I think is, if you're in a pinch, the best option.
Yeah, sure. Use that dividend, that tax-free dividend.
I used to like RPU, but I don't like that anymore. I think premium offset's the way to go.
Yeah. Sure. Well, that's a whole other conversation too, but so that's what this asset can do for you in retirement. So if you did nothing else, if you just thought about this as, hey, just another piece of my retirement portfolio, my passive income portfolio for later on in life when I'm done working for the man, or I'm done working my own business, or I'm done flying, whatever that may be. This can only improve what you're already doing, is really what it comes down to.
Yep. Yep. I think the best way I've heard it is like that. It's going to enhance whatever else you had going on anyway. Regardless of what that ignorant Uncle Bob tells you.
Yeah.
This is a good place to store capital. The best place.
Yeah. And in the meantime, you can use it for emergencies and opportunities up until you decide to quit working. Well, so you're not locked out of it. What's that?
What, I can't get a 401k loan?
No, I was just talking to, we got a client who is going through the mortgage process. He and his wife both work, make really good money, have no debt, and, trying to get a HELOC, I believe it is.
Oh, I thought you were talking about me and Tammy.
No. But you already have a HELOC. He's trying to get a HELOC just to have it for emergencies. Like, hey, sure, just in case, just to have access to capital.
He doesn't
Why
need
not?
It.
He doesn't need it. He doesn't plan to use it.
He's the perfect guy to lend to.
He's the perfect guy to lend to. Good incomes, dual income, really good money, no debt. Just wants to access the $200,000 of equity he has in his home. And it's taken forever. And they keep coming back for more and more and more information. It just proved the point. He sent me a message. It was like, this just proves why I need to become my own banker even more so.
I love it.
Yeah.
What is that worth?
Right.
The control, the liquidity, home equity, folks, belongs where you can get it. Like, everyone thinks these HELOCs are great. Yeah, they're great if you can get one, but oh my goodness. Like I said, I keep going back to it. Maybe I'll pay off the house and practice IBC in its purest form, but I think, Dave, I don't know. I'm going to just keep refinancing that thing and pulling the cash out of it and putting it in policies. But
yeah. What's the value of $1 you can't access?
Yeah, that's right.
$0. $1 you can't spend. What's the value? There you go. All right, man. Well, I think we got through about as much as we could on that topic. plenty more. If you guys want resources or something, or you got more questions about that, reach out, schedule time with us. Happy to talk. Send us questions. Maybe we should review some questions on the YouTube channel or something next episode.
We've got, I think, was it JJ? We've got somebody listening, and I don't know if he's a practitioner or an agent or not, but he might have made comments almost in every single episode by now. And I just want to say they're good. They're good comments, and we appreciate it for sure.
Yep. I love it when people listen. So why don't we end with this? We got one from one of our recent ratings on the Apple podcast from Clyde04, the Pearl of IBC podcasts. So this is a gem of a podcast on IBC. Often IBC proponents make it sound very gimmicky and a bit snake oilish. Paul and Dave break it down simply and dispel many myths and confusions about IBC. Great job, guys. Thanks, Clyde.
I know who that is.
Do you? Yeah.
I don't actually.
Okay.
Just started listening.
Started
listening. Yeah.
Well, good. Keep listening and send us any questions you got. We'll be happy to answer them. So.
Yeah, that's right.
All right, everybody. Well, hey, until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow, leave us a 5-star review if you're on Spotify, and please share this with your friends. We'll see you next week.